Hi, everyone. My name is Mike Neff. I'm one of the founding partners of Secure Retirement Strategies. And I want to talk a little bit today about insurance companies and what their solvency ratio means and how safe insurance companies really are. So, every insurance company that does business, whether it's in the state of Pennsylvania or the state of Tennessee or New Jersey or anywhere else in this country, they get audited 4 times a year by each state insurance commission that they do business in. Most of these companies are doing business in anywhere from 48 to 50 states. That's good because they're being audited by 4 times a year by each of those state insurance commissions, and all those commissions speak to each other too. That should be very reassuring for anybody who's buying these. But every company has reserves. Every company must, by law, reserve at least $1 for every dollar of contract value. The companies that we deal with primarily reserve anywhere from $1.05 to $1.10 for every dollar required. They reserve excess of what they're required to do. What does that mean? Well, it may not sound like a lot of money, but there's a big insurance company in Newark, New Jersey that uses the Rock of Gibraltar as one of their logos for their corporation, and they reserve a little less than $1 and they're a pretty sound financial company. But really that excess reserve is important because if a company, when they're getting audited, has an excess reserve, as long as they're above $1, they're fine. When the auditors look at those reserves, if a company's reserves were to go below $1, then the auditors give them 90 days to get those reserves back up. If in those 90 days they cannot get their reserves to $1, they are forced into receivership. They are insolvent. They can no longer do business in any of those states. And what happens is every other company will then take over those contracts and honor those contracts as well. That's the power of the insurance industry. That's why this is so important. So a company, we don't want any company to go insolvent, but an insolvent doesn't mean bankrupt. And there is a big difference. Bankrupt means they have no money. Insolvent means they're below $1. They may have 95 cents, 98 cents, 99 cents on the dollar. Most corporations would kill to have a balance sheet like that, but in the insurance industry, that's considered an inferior company. So the difference of 95 cents to $1, those other companies take over those contracts. They make up that 5 cents or that 3 cents per contract, and they will honor those contracts. By law, they have to honor those contracts, and they will honor them for the life of those contracts. Nobody loses money. During the worst period of time in this country's history, the Great Depression, there was never an insurance claim that ever went unpaid. The safety, the power of the insurance companies, that's tantamount to protection. We want our clients to feel very comfortable, more so than what the company is rated. How much do they reserve? The higher the reserve, the better the company is financially. We look for good, strong financial companies. I hope that explains the solvency rules, and it's been a pleasure talking to you. We look forward to explaining this to you at greater length if you'd like. So once again, go to our website, www.srsstrategies.com, or give us a call, 267-544-0333. We look forward to talking to you. Thank you very much, folks.